Hello and welcome to the latest episode of On the Money, a weekly bite-sized show that aims to help you get the most out of your savings and investments. In this episode, we're going to be running through the most popular funds, investment trusts and exchange-traded funds, ETFs, with Interactive Investor customers in the second quarter of 2025. Joining me to provide his expert insights is Interactive Investor's Sam Benstead, who alongside myself regularly interviews fund managers on camera and writes lots of news analysis pieces related to funds. Now, before I bring in Sam, I'll just briefly explain why we started a year ago covering the top 50 most bought collective investments each quarter. So for a long time now, we've been covering the most bought funds, investment trusts and ETFs on a monthly basis, but we separate them out. So the thinking was, if we bring all three together, that'll provide a really interesting sort of league table into the top 50 most bought funds, investment trusts and ETFs. So we're now publishing this on a quarterly basis. We publish a PDF report, and it's always interesting to see over the quarter how the top 50 has changed, which trends have emerged, which funds have climbed up the league table and which funds have fallen down the league table. Now, we base the top 50 on the number of buys rather than volume, and we also strip out regular investing plans, as the thinking is we want to show the active decisions that investors are making, whereas if you're regularly investing, some investors are adopting more of a set and forget investment approach, which is more passive as it's buy and hold. So Sam, we have a treasure trove of data to delve into. In the report, we take a look at the different regions, sectors and fund types that are most popular with investors. Let's, however, start with the top 10. Sam, could you run through the rankings and give a brief description of how each fund invests and why they are popular with our customers?
Yeah, sure. So Royal London Short-Term Money Market Fund it was the most popular fund over the last quarter, and we've seen that in our monthly reporting, haven't we? It's been a very, very popular strategy, and this is a money market fund and a short-term money market fund. So it's the lower risk end of the money market fund spectrum, and it aims to provide investors with a cash-like return by investing in bonds about to mature and making use of bank savings tools that professional investors can access. So very, very low risk. It tends to track the return of the Bank of England base rate, and it's used as a place to park your cash, often for when you're waiting for better opportunities, or if you just want to take a very low risk investment and see your money gradually tick up higher. And that was followed by Vanguard's S&P 500 UCITS ETFs. So these funds, for just 0.07%, track the S&P 500 index in the US. The version of the ETF that distributes income, VUSA, was in second place, and the version that reinvests any dividend income was in third place, and that stock market ticker is VUAG for the accumulation ETF. Next up, we have the iShares Physical Gold ETC, which is a Super 60 fund. So quite clearly that just tracks the price of gold, and it's backed by physical gold bars. In fifth place was the Vanguard Life Strategy 80% Equity Fund. And actually the Vanguard Life Strategy 100% Equity Fund was on the top 10 too, in ninth place. And these are fund of funds managed by Vanguard, and they're just a package of Vanguard index funds tracking different markets from around the world, stocks and bonds, to act as a one-stop shop for investors. In sixth place was Scottish Mortgage. This is the well-known growth-focused investment trust that buys fast-growing and innovative public and private companies across the world. And then we had a few trackers as well on the list. So the HSBC FTSE All World Index is a all-world tracker fund, so that includes emerging markets. The Vanguard FTSE Global All Cap Index is another all-world fund. And also, to round off the list, we had the L&G Global Technology Index Trust, which just tracks global technology shares.
So in the top 10, there are only two actively managed funds, those that are overseen by professional investors, and they are polar opposites in terms of risk. So you've got top of the table, you've got Royal London Short-Term Money Market, and then lower down in the top 10, you've got Scottish Mortgage. Now, overall in the top 50, there are 20 active funds and 30 passive funds, which are either index funds or ETFs. So I'm sure many listeners are very familiar. Just to run through for those that are a bit more newer to investing, index funds and ETFs, they passively track the up and down fortunes of a particular index, such as a particular stock market like the S&P 500 or the MSCI World Index. And some also track the up and down fortunes of a particular theme, sector, or part of the bond market. Sam, could you explain the types of index funds and ETFs that investors are favouring within the top 50? And could you also outline your thoughts on that split? So in percentage terms, 60% of the top 50 are either index funds or ETFs. And then the other 40% are either funds or investment trusts that are managed by professional investors.
Yeah, so the main theme within the passive funds on our list are that they tend to track stock market indices. So S&P 500 is compiled by Standard & Poor's, and it's the 500 largest profitable companies in America. The FTSE All-Share is roughly 600 companies in the UK. The MSCI World is about 1,300 of the biggest global businesses from developed markets. And the NASDAQ 100 is the 100 largest shares on the NASDAQ index in America. So these are the main places that people want to track. And then fund management groups come in with products and they compete on fees mainly, but also how closely they can track the index. So for example, Vanguard's S&P 500 UCITS ETFs charge 0.07%, but actually one ETF, plenty of ETFs do it quicker, but one our fund research team really like is the SPDR S&P 500 UCITS ETF, which costs 0.03%, and that's on our Super 60 list. For all world exposure, you have to pay a little bit more. So the HSBC FTSE All World Fund, which is very popular, costs just 0.13%. So that's where most of the passive money is going, tracking those main indices. But actually, the other theme is that there are passive funds tracking themes themselves. So as Carl mentioned, it doesn't have to be a main stock market index. It can be a part of the stock market. And some of the most popular themes we've seen investors want to track at the moment are technology shares, and they're doing that with the L&G Global Technology Index Trust and the iShares S&P 500 Information Technology Sector ETF, and also defense. So the VanEck Defense ETF on there. And it's something we've spoken about on other podcasts, but defense shares are extremely popular at the moment, particularly in Europe. The governments are committing to spend more on arms and on the military, and that is boosting defense shares. And then one other theme I'd highlight is cryptocurrency. So while UK-based investors can't own cryptocurrency in ISAs, and there are no products tracking the value of cryptocurrencies that they can put in ISAs and SIPs and investments accounts, you can actually buy an ETF which owns companies themselves that are linked to the cryptocurrency world. And the one that is proving the most popular on our platform is the VanEck Crypto and Blockchain Innovators ETF. And just back to Carl's point earlier, that was 60% of the 50 funds on the list are passive and 40% are active. This doesn't surprise me at all. It's a theme we've been seeing for a long time. And actually, the Investment Association data shows that 25% of money now invested by British investors is passive. So we're ahead of that. But I think our customers are very switched on, and they've seen that lower fees, broad exposure to different stock markets and themes can be a very effective way of managing your money.
Completely agree. I can really see the trend towards index funds and ETFs increasing in the coming years as, investors seek out a low-cost way and a simple way to gain a lot of diversification to global markets. I'll now turn to active funds. So in the second quarter of 2025, there were 14 investment trusts and 6 funds in the top 50 index. So compared to a year ago, we've seen demand for investment trusts fall in the index. So a year ago, there were 20 and now there are 14. This coincides with the sector being out of favour over the past couple of years. So for the past couple of years, the average investment trust discount, which is the gap between an investment trust share price and the value of its underlying investments, known as the net asset value or NAV. So that gap, the discount, has been wider than 10% since 2022. And many investment trusts have been trading on discounts much bigger than 10%. So when discounts stay at a stubbornly wide level for a couple of years, becomes more and more difficult to win over new investors, as some investors then think that discount has become entrenched. And this is particularly a problem for smaller sized investment trusts that fall under the radar or are too small for large investors to buy, such as wealth managers. Now, there are several drivers behind the drop in investment trust demand over the past couple of years, but for me, the main one has been higher interest rates. So higher interest rates, they've caused bond yields to increase to attractive levels, and that has led many investors to dial down on risk. And one of the areas we've seen a lot of investors go into are money market funds. And money market funds, the level of income that they're seeking to generate, it typically tracks around the level of UK interest rates. And at the moment, UK interest rates are 4.25%. So many investors are thinking, okay, I can pick up that level of income. Of course, it's not guaranteed through a money market fund. Why would I want to take the additional risk of potentially earning slightly higher income elsewhere of say 5, 6 or 7% in a fund that's investing in different investments which are higher risk investments compared to a money market fund? In contrast, we've seen over the past year ETFs experience an uptick in demand. There's now 20 in our index, and that's up from 14 a year ago. And for funds, the number in the top 50 index has slightly edged up year on year from 4 to 6.
And within these active funds and investment trusts, most of them are global. So investors are really drawn to the one-stop shop fund where a fund manager can pick shares from the US or the UK or Europe. So they actually themselves don't have to go out and find a different fund for a different region. So some of these popular funds and trusts include Alliance Witten, F&C, Fundsmith Equity, Polar Capital Technology Trust, Alliance Technology, and of course, Scottish Mortgage. But actually, we are seeing some quite specialist regional options as well on the list. So I just highlight Jupiter India in there, City of London, as well as investing in the UK. And then we've got a bunch of infrastructure, renewable energy infrastructure investment trusts, which generally invest in the UK.
And 2 of the funds entered the index in the second quarter. And we're going to talk about them a bit later on in the podcast, and they are Artemis Global Income and Ranmore Global Equity. As Sam mentioned, investors are generally favouring broad exposure to global markets, whether they are seeking to own the market through an index fund or an ETF, or they're seeking professional investor expertise through a fund or an investment trust. In terms of sectors, one that stands out that investors are viewing as a potential value opportunity at the moment is renewable energy infrastructure investment trusts. Sam, could you explain why we've been seeing greater investor interest in this area? And could you run through the 4 investment trusts from the sector that are in the top 50 index?
Yeah, so these 4 trusts are Greencoat UK Wind, Next Energy Solar Fund, Renewables Infrastructure Group, and SDCL Energy Efficiency Income. So of the 4, Greencoat UK Wind is probably the best known. We've had the fund manager in our studio for an interview before. And I think the main reason that investors are drawn to these trusts at the moment is that they're just bargain hunting, and they're taking advantage of low share prices and big discounts to NAV alongside high dividend yields, because I think that's just an attractive trade-off at the moment. So I think if I explain the yields and the discounts on offer, you'll see why these have been popular. So Greencoat UK Wind has a yield of 8.2% and is on a 19% discount. Next Energy Solar Fund is on an 11.45% yield and a 23% discount. Renewables Infrastructure Group has an 8.5% yield and a 22% discount. And SDCL Energy Efficiency Income is on an 11% yield and 37.5% discount. So those yield figures are backward looking. It's based on the past 12 months of dividends. So there's no guarantee you'll get that going forward. But actually, these renewables infrastructure trusts have been quite good at paying out their dividends. They get predictable returns by selling power back to the grid, and they're often inflation linked. And whenever we speak to the managers, they talk about how reliable those dividends are and what a strong investment proposition they have. But obviously no guarantees there, big discounts, but for bargain hunters, I can definitely see the appeal.
I completely agree, Sam. I think investors are looking at those discounts and looking at those dividend yields that are on offer. Of course, they're not guaranteed, and it's really tempting some investors. As I mentioned earlier, we have seen over the past couple of years some investors dial down on risk as bond yields have risen, which has increased the level of income on offer for safer assets such as bonds and also money market funds. But now that interest rates are starting to fall, and on money market funds, you can still get a very good yield, but that yield has been declining and will continue to decline as interest rates fall. I think there's now a pretty wide gap between the yields that on the safest end of the market, what money market funds are offering, and then alternative income areas, which are more higher risk, like renewable energy infrastructure. The average investment trust in that sector at the moment, the dividend yield is 8.9%. There's now a pretty wide range between the safe end and a higher risk end, and that's tempting some investors to look at this alternative income asset class. So that's a sector we've seen greater investor interest in. Now, if you compare the top 50 index in the second quarter with a year ago, we've seen some high profile fallers. So two active funds that have fallen considerably in the rankings are Fundsmith Equity and Jupiter India. Sam, what are your thoughts on why both of those funds are now in less prominent positions in our index? So just to put the figures on it, in the second quarter of last year, Jupiter India was in 7th place. It's now in 39th. And Fundsmith Equity, it was also in the top 10 a year ago. It was in 8th place, and it's now in 23rd.
So let's start with Fundsmith. And I think it's clear that performance has been the biggest issue here, and that's actually driven lots of outflows. So the past 4 calendar years, Fundsmith Equity has underperformed the MSCI World benchmark index. And so far this year, it's down about 2% versus a slight gain for that index. So it is looking like 5 calendar years of underperformance. And people are seeing that and they're thinking, why am I paying 0.94% for the I units to underperform the index when I can buy a cheap global tracker from as little as 0.1% and do better? What will happen later? Who knows? Fundsmith still has a very good long-term record, but this year Terry Smith has blamed it on his large position in Novo Nordisk, which is the Danish pharmaceutical company which owns the Ozempic weight loss drug. So shares in that company are down about 25% this year and about 50% down from their peak. And that's been a long-standing top 10 position for Terry Smith. So it's really hurt his overall performance. And the other factor is the dollar. So in his half-yearly letter to investors, Terry Smith said that the dollar weakening about 9% has been a big drag on performance because he owns lots of American shares, about 75% in there. And because the dollar's fallen, that means the returns in pounds have fallen as well. He said that was part of the reason for the underperformance, but actually if you look at the index, it's also got about 70% invested in dollar assets. So for me, it's not a very good excuse, the currency movements, and actually the main problem has been stock picking. Jupiter India is an interesting one. So it's still managed by the same team and they've been very successful over the long run. But for this one, I think it's more a case of the theme that they invest in going out of favor. So Indian equities are just less popular than they were a year ago. A lot of money moves into the sector, and I think a lot of money is probably moving out now because returns have been less good. So over the past 12 months, this fund is flat. But over 3 years, it's up 79%.
Another trend we've been seeing is demand cool for US-focused funds. In the second quarter, we saw the number of US funds decline from 7 to 5. 2 funds that exited our top 50 index were Pershing Square Holdings and Artemis US Smaller Companies. Both of those are active funds and managed by professional stock pickers. The 5 US funds that remain in the index are all index funds or ETFs, with each giving investors broad exposure to US shares. Now, it's important to bear in mind that if you have exposure to, say, a US index fund or ETF, and also have exposure to a global index fund and ETF, there will be a large overlap in terms of holdings because in the global stock market index, around 70% is US shares. Due to this, investors with global exposure already have a sizable weighting to the US. And the reason why is because US shares, they become more and more dominant in global stock markets because over the past decade, past 15 years, they have performed really well and led higher by technology stocks. So therefore, increasingly, if you invest globally, it has become more and more a bet on the fortunes of the US equity market continuing to perform well. So with active funds that invest globally, some professional investors do have a large amount of their fund in the US. Some have around the same level as the MSCI World Index. And you may also see a fund manager have a bit more than the MSCI World Index, although it is quite rare to see that. However, you also do see some fund managers go against the crowd in having less exposure to the US than the MSCI World Index. And two of them are new entrants to our top 50 in the second quarter. I mentioned them both earlier. They are Artemis Global Income and Ranmore Global Equity. Sam, you took a look at the percentage weightings to the US in both of those funds. Could you run through those weightings and could you also detail how both of those funds invest?
Yeah, I think I'll just start by saying these have been amazing performers over the past decade. So they're all top quartile versus peers over 5, 10, 1, 3 years. So they've been amazing funds. And they've done that with not much invested in the US, which is even more impressive. So Artemis Global Income has just 25% invested in US shares, and Ranmore Global Equity has 17% in US shares, so significantly less than the index. So in the case of Artemis Global Income, they're finding the best income opportunities in financials and industrial shares, mainly in Europe, the UK and Japan. Meanwhile, Ranmore is a deep value fund and it's got 43% invested in Asia. And in a recent note to investors, it said that Korean equities, because they are classified as an emerging market still, are being ignored by many global funds, and there are lots of really, really good value opportunities there. So very impressive from both of these funds, and it's been quite a successful strategy, I think, for many, holding these alongside a passive fund which just tracks companies based on their market cap weighting.
So Sam, you mentioned the Ranmore fund has a deep value investment style. So for those that are perhaps less familiar to investment styles such as value investing, I'll just give a brief description of what value investing is. So if you see that a fund invests in value shares, then they're looking for shares that they think are out of favour and potentially mispriced. However, a fund manager adopting this approach, they don't just simply hunt for value shares that are looking cheap in terms of their valuations. They're also looking for and also hoping for a catalyst to revive an underpriced company's financial fortunes. And this could be through the form of a restructuring, refinancing, or a management change. Sam recently wrote a data piece pointing out that value-focused funds have been faring well in the first half of 2025 on the back of stock market volatility picking up earlier this year. Could you pick out some of the value funds you mentioned within that article, Sam, which are not in our top 50 index?
So Orbis is one of the fund managers I would highlight. So they run the Orbis Global Equity Fund and the Orbis Global Balance Fund. And actually Ranmore manager Sean Pesh used to actually work there. So it's a very good value investment house. And we actually had the manager of the Orbis Global Balance Fund, Alec Cutler, in the studio about a month ago to talk through their investment style and where they're finding opportunities at the moment. And actually one of the little nuggets of information in there was that he still thought defensive shares were still cheap and also gold had further to run. So Orbis, a very interesting fund manager that performed very well recently. I'd also highlight Brickwood Asset Management. So Ben Whitmore is the key manager there, and he used to run about £10 billion at Jupiter in global and UK value equities, and he's split from Jupiter to launch its own fund management firm, and these funds have a track record going back just until February this year. So very new, but if you're interested in following what he's up to, I also had him in the studio recently, and he talks through his investment style and what types of companies he likes at the moment. One other, which is also being featured in our video series is the Schroeder Global Recovery and Schroeder UK Recovery strategies. So the UK manager is Nick Kirridge, and he's a very interesting value investor. So that's worth a listen or a watch if you're interested in that style of investing. And the final one I would highlight is the Dodge & Cox Worldwide Global Stock Fund, and that is a member of our Super 60 list.
So Sam's just mentioned 3 recent videos that he recorded with fund managers, and they're available on our website, ii.co.uk, and you can also watch them on our YouTube channel. If you search for Interactive Investor on YouTube, our channel will come up. And if you subscribe to our channel, and it's for free, then you'll be able to see other videos that we record with fund managers in the coming months. And that's it for this episode. My thanks to Sam, and thank you for listening to On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. And if you get a chance, please do leave us a review or a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like us to talk about via email, which is otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, ii.co.uk, and I'll see you next week.